So now coming to the most important event last week, which was the RBI monetary policy. So compared to our expectations as well, the Monetary Policy Committee voted unanimously to reduce the policy repo rate by 25 basis points to 5 quarter and retain the neutral monetary policy stance. This policy was coming at a very interesting juncture. We saw significant depreciation pressures on rupee in the last 2 months as the earlier expectations of trade deal were getting postponed. So there was a certain section in the market which believed that RBI may not be able to cut policy rates, especially in line of rupee depreciation pressures, as the rate differential between global rates and local rates would continue to come down if RBI would have cut rates in this kind of environment. Moreover, we also saw the release of GDP data for Q2 of FY26, which printed above 8% compared to RBI's expectation of 7%. So there was also this expectation that given that growth is still way above market forecast, what is the reason of any rate cut? But RBI was quite clear that while growth continues to remain high for now, going forward, RBI does expect growth to slow down. So if you look at the chart on the right-hand side, where RBI tries to project the growth for Q1 and Q2 of FY27, the growth is projected at 6.7 and 6.8, slight slowdown from the current levels. More importantly, the RBI focused on its primary objective, which is inflation targeting. So if you look at the current inflation forecast, so from a 1.8% inflation forecast for Q3 of FY26, now RBI is projecting just 0.6% inflation for Q3. And even if you look at fourth quarter of FY26, inflation is projected to be 110 basis lower than its earlier forecast of 4% to 2.9%. So broadly, if you look at FY26 average, that was already running at 2.6% forecast, which has been further reduced by 60 basis points to 2%. So given the comfort on inflation that RBI had, given the lower food prices, RBI believed that they are in a position to cut interest rates, and monetary policy should not be mixed with RBI's FX policy. So while on the FX side there is uncertainty on trade deal, there is a certain amount of FPI outflows that we are seeing, because of which we are seeing some pressure on rupee. But mixing these two separate issues, especially when domestic inflationary pressures are not there, would not lead to a right outcome. Because if you compare this situation to 2013 situation, in 2013, our local inflation was running at 10% plus. Our current account deficit was in excess of 4% of GDP. If we look at current inflation, that's projected to be 2% for FY26. If we look at current account deficit, it is expected to be around 1% of GDP, despite the trade uncertainty. So the macro outlook in 2013 and macro outlook in 2025 is very, very different. At that point of time, because of the taper tantrum in May 2013, we saw significant amount of FPI outflows in debt. And if we contrast that situation to current situation, we are in fact, despite these lower rates, compared to global interest rates, we are yet seeing debt inflows in the last 3 months, because inflation is expected not only to be stable in the current financial year, inflation is expected to be stable in the next financial year as well. In fact, in January 2026, Ministry of Statistics is expected to announce a new inflation series, which will be updated with latest household consumption patterns. So the weightages of food will further reduce, so probably the inflation will be marginally lower on a steady state basis and less volatile, because food tends to be more volatile. Also, because it will capture latest economic data points such as e-commerce sales, etc. Even some of the numbers on the core inflation side, especially on core goods, could be lower. So broadly, inflation is not only expected to be stable this year, it is expected to be stable next year as well. So in light of these circumstances, we believe RBI took the right call to cut interest rates because what's more important, especially in these kind of times when the outlook on growth is slightly moderate and inflation is stable, uh, that is the right time to cut interest rates and let interest rates cuts uh, transmit into real economy. And that's where RBI was mostly focused at. So not only RBI cut interest rates, RBI also tried to address the liquidity concerns. So just to put things into perspective, currently the system is running at a liquidity deficit, liquidity surplus of about 3 lakh crores. If we expect RBI to even take delivery of certain FX forwards, so RBI is running a negative forward book of more than $50 billion. So if RBI were to take delivery of some of its immediate forwards, you assume a certain natural currency leakage and you assume a certain CRR deployment as more deposits come into the system. By end of March 26, the current system liquidity surplus of 3 lakh crores is expected to get into a surplus of 50 to 70,000 crores. If we recall RBI's stated objective when they had cut CRR rates, RBI's stated objective was that they want to keep liquidity surplus to the tune of 1 to 1.5% of NDTL to ensure right monetary transmission. So if we were to take that number, RBI needs to keep and RBI needs to ensure that liquidity is surplus of more than 2 lakh crores even going forward ahead. So given the FX intervention that RBI has been doing in the last 2 months, given the maturity of its FX forwards book as well, RBI announced about 1 trillion in OMO and a $5 billion in FX buy-sell swap, which will release about 1.45 lakh crores in the month of December as well. So it's quite proactive because already in the month of December, around 15th of December, we will see some outflows due to advance tax, which will reduce liquidity from the banking system and increase government cash balance. We'll also see some GST outflow on 22nd December. So taking these measures was quite important, quite proactive, and it should help anchor the money market rates and bond yields as well. So RBI clarified that the OMO announcement should not be seen as a management of bond yields. It should be seen to ensure that there is adequate permanent liquidity in the banking system. So in a way, RBI can create liquidity only in two ways, especially on the permanent side, which is either through open market operations by buying bonds, which, when they buy bonds, they infuse rupee liquidity in the system, or by FX intervention when they buy dollars. So when they buy dollars, they sell rupee, this infuse rupee liquidity in the system. What they have been doing in the last 2 months is the opposite of that. They have been selling dollars to ensure uh, lower volatility in USD. So when they sell dollars, they take away rupee liquidity from the system. And hence, we believe this 5 billion is a starting point. They may need to announce one more OMO of at least 1 lakh crores in the Jan to March quarter as well. They may need to do more buy sell swap to ensure forwards remain at reasonable levels and your market yields remain quite steady. Having said that, we think probably this is the last rate cut in this monetary cycle, unless and until there is a major macro shock. So if you look at inflation forecast that RBI has put for FY27, for H1, if we take, which is expected to be around 4%, and if you take the current policy rate at 5 quarter, your real rate comes out to be around 1 quarter, which is very much in line with the 1.1 to 1.9% real rate range given by RBI. So even on a forward-looking basis, real rates seem to have reached at a lower bound. And if you look at the third quarter and the fourth quarter inflation probability of FY27, although RBI has not projected that for now, because of the base effect, because the current inflation is just 0.6 and 2.9 for fourth quarter, next year second half inflation is probably likely to be upwards of 5%, just on the base effect. So from a overall steady state perspective also, we believe that the current policy rate is quite appropriate, given that the rise in inflation in FY27 will largely be base effect driven and not due to underlying factors. We think RBI will be able to maintain these policy rates lower for longer. So at least for the next 9 to 12 months, barring any major macro shock, we expect RBI to keep rates at current levels. We expect liquidity to remain quite steady. So in a way, this situation is just, uh, like post-COVID situation where from 2020 till 2022, rates remained low. If you would recall, after cutting rates to 4% just post-COVID, from May 20 till Feb 22, RBI kept policy rate at 4%. So for almost 2 years, rates remained at 4%, and liquidity remained abundantly surplus. This is the scenario we are foreseeing in the next 9 to 12 months. That given lower inflation and given that growth is likely to be moderate, we do expect RBI to keep rates steady. What if a trade deal happens? Will inflation pick up? Will growth pick up? And what will RBI do then? We think even if the trade deal were to get announced probably this quarter or the next quarter, we don't think it will materially change the growth outlook going ahead. It will probably reduce further downside risk to growth because, as we discussed previously, India does not export a significant amount of goods to the US, but it does improve the sentiment. It does reduce downside risk to the growth outlook, but it does not change either inflation or growth outlook trajectory very, very meaningfully. So hence, we do not think even if the US trade deal were to happen, probably RBI will have to intervene less in the FX market. Probably USD INR will start to stabilize, but we do not think that it will necessitate any action from RBI on the monetary policy front.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.